That's the markets. If we actually look at the underlying problem of CDOs, and for those of you who are bankers in the room, we produced a nice little table that sort of mimics the English Premier League. This is the Premier League of CDO losses and write-downs. Right? The interesting thing is it's the global equivalent in banking terms of Manchester United, Liverpool and Arsenal, i.e. the guys who are meant to be smart and have all the best players and the best risk management, who are up there where they should be in the Premier League, having posted some of the biggest losses we've ever seen in the history of banking. Right? They're smart guys. Okay? And then, of course, some people think they're super smart and they start buying the stock of these things. I won't comment on that. But all we're saying is, and by the way, professionally, I've spent most of my life being a bank cleaner. So what I do is, now I manage money, but before what I used to do is clean up banks in crisis. So we think we know a little bit about this. That's why I came to Asia for the Asia financial crisis. This is just the tip of the iceberg. This is not over yet. The figure estimate that we gave 3 or 4 months ago was around 500 billion of losses from CDO and CDO-related, mortgage-related securities. Remember, there's Alt-A, there's Alt-B, there's single A, there's double A, there's triple A still to come, all of which get affected with mark-to-markdown laws. So what you're seeing is stuff that is going to continue to get worse. And on top of that, there's a spillover effect into the rest of the credit stuff, good prime credit in other areas. There isn't a name of a major bank that isn't up there. Even completely unheard of banks in the middle of Germany. The Germans are great. They have fabulous banks whose names you can't pronounce. You've never heard of them, but they've still got enough money to lose a few billion here. Germans have been doing that for a long time. So, this is not over yet, right? This is not over yet. And in terms of the total extent of the losses, we're actually looking at a total credit buzz in one. So let me hope this works. Hang on, I can get the mouse over here. And if you could just turn the volume. If we look at the leading indicators, I actually like leading indicators, the OECD leading indicators. They don't work well for micro-market things like auto or retail sales, but they work very well for the overall system picture as a whole. And again, OECD numbers we like the best. You can see that pretty close to zero, right? Yes, there's been a little short-term bounce recently since monetary easing, but you don't want a number that is hovering around zero. What that means is leading indicators are the global economy is at stalling speed. Right? The engine has stopped, and there's not much new to tick it up. Now, the world's largest economy, right? This guy's finally getting it. I'm not a great fan of. He's a little bit slow, but eventually, even he gets that the US economy is most probably not in the best shape. And if we take a look at the numbers, just as well, this is his last term in office, but this is how he's going to leave the state of the ship, right? What I always do is I just focus on a few of the best leading indicators out there. The top line are the corporate sector and corporate profitability indicators. The bottom is consumer stuff, and those are indicators of risk, gold price and inflation, consumer price index. Now, what is interesting, and this is why guys like me are so worried, right, is all those fabulous V-shaped recoveries from recessionary cycles in the US economy, the resilience of the US economy, has always been because previous recessions have always been classic cyclical recessions, which are corporate profitability reduction, corporate investment reduction, right? So then they reduce employment and the corporate sector goes down. So you would be seeing less investment spending, less corporate earning, less business confidence, manufacturing reducing, inventories piling up because they can't sell stuff, right? And you're seeing all that now, right? Interestingly, it's tipped into the corporate sector now, but 3 or 4 months ago, we weren't seeing that. What we were seeing is down here in the consumer side, a massive drop in consumer confidence, some drop in consumer expenditure. Just recently, picked up a little bit in the first quarter, it's very, very low, right? And a very unhappy consumer, plus rising risk on consumer price index inflation. This is a consumer-led, not corporate cyclical profitability-led recession. The US hasn't experienced a consumer-driven recession for a long, long time. That's why this is going to be bad. What has always been good about previous recessions is these guys carried on going to Walmart and spending money. Okay, the fact that it wasn't always their money they were putting it on credit cards is almost beside the point. They carried on spending money. This is the first time the US consumer is leading the recession. And the US consumer is leading the recession because of a drop in confidence that comes from a massive hit to the biggest single balance sheet item in the average US consumer and household's balance sheet, which is a house. Okay? For most ordinary people who aren't multi-millionaires, right, the average regular Joe, the house remains the major item on the balance sheet, the major store of wealth, the major source of comfort and confidence, and allows you to think, oh, I've got a piggy bank and I've got this much equity, so I'll go and spend some and take credit out of the house, refinance, and put it into consumer expenditure. And that is what's taken a hit. Okay, so all of this clearly ties back to this rather oddball trigger that instead of being a corporate profitability and cyclicality typical recession, this is driven by the consumer and it's driven by what's happened in housing. Now, as we all know, the ultimate cause is this CDO crisis, right, which everyone talks about, well, what exactly is this and can you explain it and how does it affect me and how long is it going to go on? And by the way, why was it that rubbish that was packaged up as real low-grade stuff magically becomes fabulous AAA grade stuff that can be sold all over the world? And everyone thinks it's sort of AAA and it's actually sort of single B. And of course, it's actually, the magic is all in the name. So rather than me try and go to long economist explanations of what this thing is all about, I'm going to show a very, very short 3-minute film. I told you there would be a movie. Right? It's a couple of Brit guys. I mean, you have to pick the Brits because they can be politically incorrect. So we can say things the Americans can't. Right? And you just need to listen to this. It's from the South Bank show. It's a couple of guys called the Long Johns, who are brilliant comedians, and they get it just lost to US banks, US economy, and some of the linked major European and British banks of about, we think, $1 trillion. Now, the interesting thing is you think, my God, $1 trillion, this is going to be the biggest credit meltdown, the biggest write-down in the history of the planet. That is not actually correct. The telecom bubble, when you add up all the numbers of all the losses, not mark to market, but actually taken on the books of all the banks in the world, and corporations that were holding this stuff, it also came to $1 trillion. And the dot-com meltdown that happened a couple of years before that took out about 0.7 of $1 trillion. So this is starting to become a fairly regular pattern of extreme irrational exuberance and asset bubble, extreme speculation in an economic model that we think has got out of control. And I've always been a fan of the US economy and model, but there are times when you start shifting too much to non-real speculative financial assets. The major investment banks in the world, who are all American, have essentially become giant hedge funds. There is a lot of liquidity sloshing around that goes into this funny off-balance sheet industry that is largely unregulated, so it's like a giant OTC market, and that's why this stuff is starting to become rather regular. If you think there isn't going to be new major regulation coming out as a result of this, you're wrong. Right? This is going to be the turning point, we think, that will lead to a lot of tightening on the freedom that investment banks and bankers in general have in the world, ever since the Glass-Steagall was let loose and banks were let free to do their own thing. So a lot more problems coming out of that. Let's look and see where the overall global GDP growth numbers are going. We like the IMF numbers. We tend to use that. These are the best researched and the most solid. What I love is the fact that every month, we check up with the IMF. It was going to be 4.6% global growth, then it went down to 4.1% global growth at the time we did this in February, and then 3.7% in March. They're getting pretty close to our view, which is going to be about 3%. Okay, 3% we think is the high end, not the low end. Now remember, for strange folks like us, economists, we have various arcane rules that we've sort of put in place over the years. We've always taken 2% global growth as being a recession figure. The world actually has to have some growth to be a recession because of the disparity between fast-growing developing markets and developed markets is not actually zero, it's 2%. So anything that starts getting close to 2% means the world is in recession, not just G3 countries, Britain and America and so on. It means the world is in recession. That is bad news. When you have a global recession, everybody feels it, all asset classes across every single country, every single range of liquidity demand.
during this summer there have been actual causes behind the